Good morning, friends. I request our chairman, our branch chairman, CA Rinkesh Shah and MCM CA Jiten Trivedi to invite our speaker CA Chintan Patel sir on the stage. Again, good morning to the esteemed seniors, members on the dais, and fellow colleagues. It is my privilege to introduce our distinguished faculty for today's session, CA Chintan N. Patel. He is an FCA, USA CPA, USA CISA, CS, DISA, LLB, MCOM, certified in DAS, and certified in forensic accounting and fraud detection. With an enriching experience of over 25 years, he is a partner at BNPS and Associates LLP and has served the profession with great distinction as a past regional council member of WIRC of ICAI and past chairman of the Ahmedabad branch. He is also a co-author of the book Quick Guide to Ind AS and ICDS published by Taxman, a mentor and editor of a knowledge update channel on YouTube, and a prolific contributor with articles published in ICAI journals and newsletters. He has delivered more than 500 presentations across India and internationally, including Dubai, Muscat, and Salalah. He is also the chairman of the auditing committee of WIRC of ICAI and possesses rich hands-on experience in Ind AS, KPO, statutory audit of listed companies, Companies Act, risk advisory, GST, and income tax. With such vast experience and knowledge, we are truly fortunate to have him with us today. I now respectfully invite CA Chintan Patel sir to take over this stage to share his valuable insight. Okay. I now respectfully to CA Rinkesh Shah to felicitate CA Chintan sir.
Before handing over charge to Chintan sir, I would like to just add something which already Yash has mentioned in his speech about the introduction. Frankly speaking, whomever is sitting on the dais, off the dais from first row to the last row, is aware about who is Chintan Patel. Because knowledge is the key personal, and a person who became the leader with the knowledge, very few leaders we have in the system who has the knowledge in depth about the subject. It may be a US GAAP knowledge, or it may be an Ind AS, or it may be an audit. When this seminar was designed, the first name came to my mind, that was Chintan Patel. Sir, thanks a lot. And it is our home branch. And as always, you are available. And in the first instance, he gave the consent. Sir, once again, thanks a lot. I request you to take the session, sir. Thank you. Thank you.
Good morning, everyone. Chairman of the largest branch in WRC and second largest branch in India, my dear friend CA Rinkesh Shah. Managing committee members, and again very close to me, CA Jiten Bhai, co-editor C. Yash Desai, colleague in my conference, faculty CA Shians Bhai, seniors and friends, good morning everyone. Rinkesh Bhai called me around, I think we have a discussion 2 weeks back about session on Ind AS, and we have been contemplating that how the session should be kept. So we earlier thought it should be half a day, full day, and then he said, now we want to have full day because let's have focus on Ind AS. Let's encourage the members in Ahmedabad to really focus that Ind AS is something which is actually a full-time activity. It is not something which is only a partial or part-time thing. So that's why with that objective, he has kept full time only on Ind AS, full days, like 6 hours. Ind AS is a very big thing. Really fortunate enough for all of us that today the branch is being chaired by somebody who is also a technical knowledge person. because somebody who has worked for India, somebody who has worked for NRI and other things, and he is able to understand the importance of the technical things, and then he's able to create. So I must compliment Nikesh bhai for taking the branch at a newer height. I am sure that under leadership, the branch will definitely have consecutive first time all 4 branch awards. Jiten bhai also, he has been again, I mean, actually both the particular persons sitting here, they both are also co-speaker with me at various occasions. And Jiten bhai also has been very good as far as accounting and auditing income tax is concerned. He has been faculty. So really proud to have the managing committee includes a technical person. I think that is what is needed. There is a CA profession, it is not a political party. And as a part of CA profession, we need the candidates who have understanding and passion for technical knowledge. That is really important for all of us. The topic seminar that is on recent EAC opinion. So when you just talk about expert advisory committee opinion, I think the most important thing which we all understand that today we are going to discuss primarily not only with respect to learning Indias. This is not our learning Indias. It is about talking about India's convergence and learning from what already being done. So when you talk about expert advisory opinion, I am going to touch upon the practical case studies, the issues which are real life scenarios. Because expert advisory committee opinion, that really means that the corporates have approached ICAI on a practical issues where there is a dispute, the difference of opinion between the auditor and management. By difference of opinion, they wanted to get the expert guidance of ICAI that what is correct. That means what first, there is an issue which is a practical issue. Second very important thing is that there is a difference of opinion. That means both the parties believe that they are right. And then they want the expert opinion of ICAI. So during this presentation, I am going to cover practically more on the issues which are already addressed by ICAI. And that case studies we are going to cover. Obviously, during this case study coverage, we will also look at the India's, particular India's, the standard which talks about why the ICAI opined that. That also will be covered part of the case studies. So let us look first case. The company, a joint venture for MRTS in Delhi or NCR, received interest-free subordinate debts from Government of India and GNCTD as a part of funding pattern for execution of metro projects. The total amount of interest-free subordinate debts received by company until 31st March 2023 are rupees 11.71 lakhs. The amount is actually 11.71 lakhs and then lakhs, so it is a very big amount. And the word which is used is interest-free subordinate debt. So subordinate debt is debt. Generally, it is lower than the primary debt. So in case of liquidation, so if something happens, then the subordinate debts will be given a second priority towards other liability. That's why it is word subordinate debt. And it is an interest-free subordinate debt. These debts are accounted as a financial liability under Ind AS 109, initially recognized at a fair value. C&G raised concerns about non-compliance with Ind AS 109 regarding amortized cost. The company has made inquiry to SBI to provide interest rate, however, not provided due to restrictions for providing such loan. Now what happens in this particular case, that subordinate debt of 11.71 lakhs was being received by the company. It was interest-free subordinate debt. The company has accounted interest-free subordinate debt at the transaction price and that they assume it is a fair value. So the C&G argued saying that this amount is not a fair value. You may say it is a fair value, but it's not a fair value, it's a transaction price only. So you need to do a discounting, you need to arrive at the fair value and then only you do accounting. Now at that time, the management refers to Ind AS 109. It says under Ind AS 109, it says that financial asset and liability, they both need to be classified and measured at amortized cost, financial liability. And for at amortized cost, we need to arrive at the fair value. Now, The CNG says that you need to look at the comparable market interest rate to arrive at the fair value. Company said that we have approached bank. They have written an email to State Bank of India asking that this is the loan which I received from the government and this is the amount which you received. This is the purpose of a loan. Tenure of the loan is this much. Interest rate is this. Now you kindly provide us in case if you want to really give such kind of loan, what would be interest rate to me? Because if I want to understand fair value, how can I understand fair value? So there is a let us approach to nationalized bank. There is a third party. And if the third party is providing me loan, it will be best for me to understand what interest rate I am getting it. SBI said that we will not be able to, we don't have any such kind of loan with this kind of terms and conditions, and we don't offer this kind of loan, so we are unable to provide anything. Based on that email, the company argued that we have already approached the terms of loan which are provided as such that it is actually a transaction price value that, and we are unable to get actually interest rate from bank. So the accounting which you have done is correct. They approach ICAI. The ICAI has looked at the whole terms and conditions of the loan. What is most relevant here is that the para 5.5.1 of Ind AS 109, it talks about a case that in case of financial liability, it should be classified and amortized at a transition date of fair value. Then background material application guidelines of 5.5.1, it mentioned that in case if you are for arriving at the fair value, you have to look at the comparable rate, and you can also look at the present value of the cash flow analysis. So how much amount of cash flow is going to be received and paid, and then you can arrive at the fair value. To carry out that cash flow analysis, the management claim that they are unable to do it because they don't have this interest rate available. Now, on that particular part, ICAI says that let us look at Ind AS 113. Ind AS 109 talks about the case where you need to have classified and measured fair value. Fine. Paragraph 5.5.1 talks about the fair value, how to arrive at. Background material provides you guidance that you have to arrive at a fair value by considering the cash flow analysis of the maturity profile, and you have to apply discounted interest rate. You are saying interest rate is not possible because I applied to SBI, and SBI said that we don't have this kind of offer. Now, how to do valuation is not possible, so I am doing transaction prices my fair value. So ICAI says that you need to refer to the 113, Ind AS 113 fair value measurement. It says that how to measure fair value when the readily available market price is not available. So Ind AS 113 provides you level 1, level 2, level 3. First level is there where market rate is available easily. Then if it is not available, you go look at observer inputs. Observer inputs can be such where I refer to the bank and the bank provides me the rate and I can use that particular rate. And level 3 says that if observer input is not available, then what is to be done? Then you have to refer to the valuation techniques. So Ind AS 113 provides you complete guidelines as far as how to measure. Not having interest rate from the bank doesn't absolve you from responsibility to measure at a transaction price, and therefore the accounting which is done by a company is not correct. I hope that's clear. To any question so far on this particular point? Right. So I think Ind AS is something which I generally understand that for understanding Ind AS, there has to be some kind of communication, discussion, interaction. So wherever you feel that you have some questions, you have doubt, then obviously we can have a discussion. But here it is really good. Why? Because the ICAI has already provided opinion. So at the end, discussion can be done just to understand why ICAI believes so. However, the end opinion is confirmed, and that what we have to understand why end opinion is coming, that can be done. So the opinion say the company's accounting treatment may not be correct and suggests using valuation techniques for fair value measurement, and that is what this particular standard talk about. Second important questions, consolidation of the financial statements of Section 8 company with a sponsor company. Yeah, please. Yes, yes. So basically, what happens that whenever just you refer to expert opinion, what they do that they start with that this particular opinion only gives impact on the asked question. So there are 5 angles possible. But expert opinion, they start with that you ask me only questions, so I'm going to only answer to that particular questions. I'm not going to comment on anything else. But yes, but this government is definitely going to happen. So first, you just look at practically what will happen. We'll do fair valuation of that particular subordinate debt. That fair valuation of subordinate debt will come a little lower amount than the transaction price. The difference between these two is again the thing which we do understand that how to do accounting for that. For that, we do again refer to Ind AS 20 or some of the standards to understand is it a government grant, is it the nature of the equity contribution because government is providing, because government owns that particular part. So that is something which happens at step 2 once we arrive at step 1 part. Now coming to consolidation of the financial statements of Section 8 company with a sponsor company. I think this has been it's actually a very, very big and critical issue because when we started doing Ind AS implementation for so many years back, a lot of large corporates and mostly all of the corporates have their own CSR arm. Because Companies Act 2013 requires that you have to spend average 2% of NP and generally everybody wants to do by themselves. Instead of giving contribution to trust and then trust does this, they want their own arms. So what they've done, a lot of large corporates that they have their own company, Section 8 company they form. The main company gives contribution, CSR contribution to Section 8 company. The Section 8 companies makes a like expenditure as per the objective of the CSR and in compliance with Companies Act 2013. The question which arose was that whether that Section 8 company is to be consolidated by a holding company or not. This is actually, sometimes it seems that it's really easy to understand, karna hai to kar lo, kya fark padta hai. But if you just look at the practical aspect of that, it is really complex. One. Second very important thing is that management perceive that consolidating this Section 8 company may not be able to give an actual right picture to investors. But when you say consolidation, consolidation is a line by line consolidation. That means what? Every line item of a Section 8 company is being consolidated in the operational company. Now the operational company line items are related different than the Section 8 company's line items. So management generally tries not to have consolidation. So far, the decision has been taken by a lot of corporates in India that Section 8 are for non-profit. One. Second very important thing is that basically the objective of Section 8 company, am I getting any benefit? The answer is no. Whatever amount which is being lying with the Section 8 company, it is not going to be for me. Tomorrow if I close down Section 8 company, then can I get the profit, can I get the amount which is lying in the Section 8 company? So the answer was no. So on the pretext of that particular thing, it was being ignored for so many years. Now the question has been asked to ICAI on that. It says a Section 8 company, not profit was established in 2021 as a wholly owned by a listed sponsor company. The sponsor company contributed solely for CSR purpose and has directors, one also serving as its CEO on the Section 8 company's board. Section 8 company's profit or income can only be used to further its objectives. No profit or benefits can be distributed to members. So the first we're talking about that board of composition. Second we're talking about that the profit, if any, or surplus. The word profit may not be correct also for Section 8 company. The surplus which has been there with the lying with the Section 8 companies, it cannot be distributed to the shareholders. The company had consolidated Section 8 companies financial under Ind AS till March 2023, but sought clarification. Now, in this case, it was reverse case. They have been doing consolidation of Section 8 company for around 2 years from 2001 to 2023. Thereafter, they fought, means is it required or not? Means we are doing consolidation, sometimes management also believes that. So they approach the ICAI to provide the guidance about whether Section 8 companies to be consolidated or not. What is your view on this? Okay, so one answer is a control. If control is there, is required. Now, control, how control is there, that is the very important thing, because Ind AS 110 provides you a detailed guidance of determination of control. If control is there, agreed. Now, whether control is not there or not, that is the question. So, for a Section 8 company, control is there or not? Yes.
I don't have a power over a return. An NGO or a Section 8 company is solely for the compliance of CSR or Companies Act, so bound by any statutory act. So I don't have a power over their return.
Correct. So, that is again one of the basic, very important fundamental questions raised by management. Why we are approaching is that, means the returns, I don't have power. CSR is the main objective, and Companies Act 2030 talks about the application of the fund for particular purpose. So then it says that I don't have power, even the money which I'm going to receive, I'm not going to receive anything. It is amount contributed. Now, then why I have to consolidate it? Anything else? Anybody else?
I would say consolidation is required because it involves diversion of funds from a listed company to other company, and that's an outflow of funds, and that should be proper fair disclosure to shareholders. How much money company is spending on other companies without any return, and this is the requirement.
Correct. But sir, here management says that a listed company has diverted or spent money to a CSR company. That disclosure is only provided in listed company's financial statements. That 500 crore rupees of amount as per CSR requirement I have given to XYZ Trust, very in Section 8 company, which is being partially owned by a company. The purpose of that was CSR, and why this, that is already disclosed. The purpose is consolidation. But I understand that. I am just taking your points. We'll take it right, sir. Okay, sir. Please.
Because consolidation only tell you the overall rate of return. Overall rate of return.
Agree. But here management says, okay, now, sir, probably why I'm arguing is that only to have a healthy debate. There's no objective to counter argue. The only purpose, so the company says that overall return is not of any use to you. We are not there to earn from the Section 8 donation. They are only for the purpose. See, only it is parked at particular unit, and they will do it throughout the year for the purpose again specified by the sponsor company. It is not the Section 8 company will do whatever they want. I have already directed you that you have to use for CSR, which is under Section 135 of the Companies Act 130, and you do it. Now, the return is, there is no return at all. That's what they say.
Yeah, that's the reason why we should, how much amount, consolidation will reflect clearly the non-productive use of the resources.
Okay, fine. Done, sir. I think somebody, you were saying.
Yeah, so the directors of the sponsor company are also on the board of the Section 8 company.
Correct.
One of them is also the CEO.
Yes.
So they substantially have the control over how the funds that are diverted to the CSR company are going to be utilized for the respective CSR.
Correct. Correct.
So that is also one of the parts of the definition of control, which is
Fine. So that is one of the part of definition. So when we have to arrive at the conclusion, we have to look at three parts. There are three limbs in the kind of definitions. So one of the part is satisfied. What about the other two parts? No, that fair enough. Yes, sir. Can you just little bit CSR 100%? You are saying? No mandate. Correct. Okay. Okay, so he's adding additional point that we are talking about compulsory CSI contribution. For example, it's not compulsory CSI contribution. I have made voluntarily. Okay. So you are saying if it is a voluntary contribution, then what is your suggestion? Do you feel consultation should be done or not do done, or you are asking a question to me? So flipping mat karo yahan pe already, but we'll definitely take care. So what is your view on, in case if it is voluntary or mandatory, do you feel the consultation will be different or it can be same also? I believe that it will be. Okay, fine. Anything else? Right. So I think we have to refer to Ind AS 110. Under Ind AS 110, it defines control. So I think if it's control, control is required. So we're coming back to, is it control or not control? And control is defined, and if you just look at Windows 110, around 70 or 60% of the pages of Windows 110 is only for control definition. What is control? Definition control. That on that they discuss a lot of things. So control is defined where there are three main limbs under control definition. One is A is a power of investee, B exposure or right to variable returns, and C right to use, ability to use power of investee to affect the variable returns. I think these are the three main conditions under Indian 110. And then we need to just look at every part. If whether A is satisfied, if answer is yes, look at B. If B is satisfied, go to C. If C is satisfied, all three yes, then control is there. If control is there, then we will do consolidation. Now let us look at first condition, that is A, power over investee. Now here, one thing is wholly owned. That means the shareholding is 100%. Second very important thing is that director is also there. So the two things are there. One is shareholding and second is directorship. They both gives a feeling that the power over investee is there. So point number A is being satisfied. Obviously, when you just look at Indian 110, power over investee, it talks about relevant activities and that how relevant activities are being done. So a lot of things are there, but I'm not going to that understanding or definition of relevant activity, but power investee is being satisfied. Point number B is that exposure to variable returns. Exposure or right to variable returns. Now here there's a lot of debate and management also argued intensely with the particular ICAI and the CAG about is there any variable returns or not. Because they talk about that the amount which I contributed to the sponsor company, it is for a particular purpose. That is mandated by section 135 of Public Act 2013 CSR contributions, and I can use or I have directed it to use only for that particular purpose. So had it not been my company, had it been any trust, they only do the same thing, because it is my obligation to say that when I contribute to particular trust, then they have to spend money for a CSR purpose for which I have given things. Now what is returned to me? There is no return to me. It is amount I spent towards CSR. Whether it's my company, other company, I have no control over that return, only to satisfy the requirement of the Company Act 2013. So there is no financial possibility here, even as far as the law is concerned, as far as Section 8 company's constitution is concerned, which is called MOA of the company. The MOA of the company also says that the amount cannot be distributed to the shareholders of the company. So whatever amount I contributed to them, I'm not going to get any return from that. So variable return, when you just talk about, it is not there. Here, ICAI has said that we differ to this respect. The variable return doesn't mean only a financial return. It also includes non-financial return. When you enter into a CSR obligation and when that particular company spends money on your behalf, and in that case, the reputational and brand image is built up, and that brand and reputational image is also returned to a company. Plus, how to spend, where to spend, this all that, even though part of CSR requirements, but the variable returns as include non-financial returns, so any change into that execution will also have impact on the reputational image. So therefore, variable return is there. You can't say there is no variable returns. Come to the third part. Ability to use power over investee to affect variable returns. Due to your controlling nature by of the shareholdings and by directorship, you already have right to direct and how and where to use the things, and then how it can impact your non-financial returns also. So by that analogy, the ICAI has concluded that even though it is a Section 8 company, control is there because of all three definitions which are fulfilled. Therefore, a listed company or any company which is a sponsored company, they need to consolidate. And that was actually this particular expert's opinion has been very, very important landmark change, because A lot of clients, a lot of companies have taken that stand that Section 8 companies' purpose are different. It's not for profit, so it is not to be consolidated. Primary objective of India is profit making. If we consolidate, it may not give a right picture. But with this particular expert opinion, I think that particular controversy will be settled down, and then probably, obviously, for each particular company, there may be assessment required. However, if it is Section 8 company, only by Section 8 company you can't say it is not required. Consolidation is to be required. Fine. Any question here? So control as defined by Ind AS 110 is based on power over investee, exposure to variable returns, including reputational, compliance, statutory intangible asset returns, and the ability to affect those returns. The sponsor company as 100% shareholder has decision-making rights and is exposed to variable returns such as reputational benefits, penalties for CSR failure, and synergies. No exemption exists for Section 8 companies regarding consolidation under Ind AS 110. Therefore, the sponsor company is required to consolidate Section 8 companies' financials. Next is accounting treatment for shareholders' loan provided to joint venture company. A government-owned refining company with a 3.0 MMTPA capacity, majority owned by O Limited at 69.63%, with Government of Assam and E Limited holding 26% and 4.37% respectively, approved a shareholders loan of Rs 655 crore to its joint venture A Limited for a biorefinery project. So the government-owned company, which are a part of joint venture, they have provided a loan to a joint venture A Limited. The loan was unsecured, split into two agreements, Rs 261 crore and 393 crore. So there are two kinds of loans. Both are not a similar nature. They both have a different nature as a loan is given. Repayable after 15 years or after 11 years from the commercial operation date, COD, with an interest rate pegged to Punjab National Bank's term loan rate plus a premium. Interest up to commercial operation date shall not be accrued and paid. How the accounting of loan to be done by the company? CAG observed, okay, that is first part, let me look at second part later. So basically here, the loan is being given to the joint venture company, and the terms and conditions are such where the repayable after 15 years and after 11 years, that is the normal repayment condition can be 5 years, 11, 15 years in each particular loan. Purpose is very clear for the purpose of the biorefinery project. Now the condition which has been the issue of discussion in this particular case study was that the interest up to commercial operation date, COD, shall not be accrued and paid. That was the point when the arguments and discussion has started. The company has given loan to a joint venture company, so it is a financial asset for a company which is given loan. It is classified as a financial asset and it is to be measured, amortized and measured at amortized cost. Now, the question was again on the how to do amortization cost. So it's a effective interest rate method to be applied. Okay, fine, EAC to be applied. So then the question was going to be pictured that up to a particular COD date, the interest is not being receivable. Company has accounted saying that anyway we will start recognition interest only after COD date. Till the time it is not going to, or we will not consider that amount to be amount which is not to be receivable for COD date. The auditor argues saying that the interest not payable up to COD date is not a market interest practice. Had it been not a government, had it not be a joint venture company, provide if you approach to any financial institutions and then if you want a leeway saying that basically you give me a loan or give it this, that for this period I will not make any payment, then the interest rate won't be the same one. Interest rate will be different because they also has a risk which has been added here. There is also a loss of time value of money which has been there, therefore the interest rate would not be pegged only at that particular level. So, but then the company argued saying that is COD date is again, anyway we are packed with Punjab National Bank's loan rate per plus premium. So our premium will again cover up that particular part. That discussion come to picture. Premium is what? How much premium is there? What is the fair value premium? The fair value premium takes care about the because it's unsecured loan, right? It is unsecured loan, correct? So it's unsecured loan. So whether the premium which you're talking about is only of unsecured loan to cover security risk, or it also talks about that particular point. Now let us compare with that particular market interest rate and then to arrive at that part. So the first case study when we talk about, we discuss about a financial liability perspective. In this particular case study, we're talking about a financial asset perspective. So here again the para 5.5.1 of Ind AS 109, that talks about financial instrument in together, which includes financial asset, financial liability both, and talks about amortized cost, and then again talks about that you have to look at the cash flow analysis till the maturity, and then you have to do discounting of therefore. So by analogy of that particular point, again the ICAI has come to conclusion that you need to consider the waiver of not charging or not receiving interest till COD date is something which is not in accordance with the market practice. So whatever waiver you received, that you have to consider when you arrive at the fair value as on the transition date, and therefore you are working for discounted, and to arrive at a fair value should also consider that part, and the interest rate at which you should discount, that should also be considering the fact that you are giving a waiver up to the COD date, that has to be considered. And therefore the both are on the same line, where the ICAI makes it very clear that when you arrive at the fair value, you have no option. There are a lot of things are available. You have to consider every points and compare the market, and then you have to judge that whether the interest rate charge is correct or not, and therefore that is the fair value, and that fair value to consider at the time of transaction price. Now second point which they asked was, CAG observed that the company accrued rupees 39.34 crore as interest income, effective interest method as per Ind AS 109 on the loan, reflected in the non-current financial assets and other income, even though the biorefinery had not reached COD and interest was contractually not accruable or payable until that date. CAG suggested making provision for possible non-realizable interest on this basis. Is it required to create provision for towards non-realizable interest income? So first point was how to compute. What is my interest cost by using effective interest rate method? That's the first point. For that we concluded recently that for that you need to also consider the interest rate which is different than the transaction exchange rate, because the fact that up to COD level interest is not liable, that is to be considered. Now second question which is talking about here is that now up to COD, interest is not basically receivable. However, by applying EIR method, you amortize, right? So in EIR method, effective interest rate method, what is being done that over the period of the life, the amount of interest is amortized, even though interest is not received in the books of accounts, the entry is passed. So generally, for example, if I have given a loan of how much? Loan of, for example, 654 crore rupees, right? So 654 crore loan is I have given. I will first do discount by applying interest rate. It will come to around 400 crore rupees. So 400 to 654 crore rupees, that unwinding of interest will happen over the period of the loan, even though COD is not reached. Now the question comes that now when you do unwinding of the interest, you recognize income in your P&L account. Now CAG says that COD is not still reached. You are recognizing interest income, COD is not still reached. It is subject to issues. So where it is doubtful that till COD is reached, you should not recognize income. Because it is subject to doubtful, still COD is not there. Now here ICAI says that the amortization by using effective interest rate method is by application of Ind AS 109 principles. So COD reach or not reach is not relevant as far as amortization is concerned. So therefore, the accounting treatment of company of amortization of interest, even during the COD period at interest income is correct, even though in the first case as we discussed, that interest is not appropriately recognized. However, the amortization of interest even during COD period is correct by applying the principle in Ind AS 109. Clear? I think મને ખબર છે ભાઈ ઇન્ડિયાસની અંદર ડિસ્કશનમાં તો પણ if you feel some questions are that થોડું heavy થઈ જતું લાગતું હોય તો we all are here only for to discuss on that part, બરાબર? એટલે થોડું heavy તો થવાનું જ છે. But it's always good to have a revision of what we learned, revision of the principle which you already seen, and nothing base can happen rather than just looking into these case studies. So if no question, I will just go further. Sugaja? Sorry, again? Correct. So basically, whenever we do the fair value, the difference between these two, now that again a question. For example, 654 crore rupees is what is the amount of loan. When I do present value of 650 crore rupees, it comes to 400 crore rupees. So 254 crore rupees is something which is a differential amount. On the day of the transaction, the question comes to mind, what is to be done for 250 crore rupees? On liability side, I reduce 250 crore rupees, which I will build up over the period. But what about the first entry of 250 crore rupees? Now, here again, assessment to be done. That why I am doing this? Why I am offering them the lower interest rate? Why I am offering them a concessional? What is the reason I am offering this benefit? The reason of that benefit in doing this particular thing is that because of joint venture agreement. As a joint venture company. So the cost which I am incurring here is nothing but my additional cost of investment in joint venture company. So that will be my differential amount when you just move at a transaction price, and then there will be unwinding happens over the period of time. It is non-cash contribution. Whether it will have any impact, if you consider non-cash or cash, how it is impact? I mean, I just want to understand that. Yes. Equity, not capital. Equity contribution. Other equity. Correct. So basically now when you just refer to from joint venture company, we look at Ind AS 32. And then based on the Ind AS 32, we classify into equity and liability part. And if it is equity part, then that will be. So there is possibility that the both company can have separate accounting. Possible. But generally it doesn't happen practically. Both are under the same group. So but in that case, it will be part of the equity and it will lock off once consolidation is happening. Yes. No, not share capital. So share capital under Ind AS has been clearly separated. Equity is a very big word, which includes the three parts. One is share capital A, then B, other equity. Again, other equity also, there are a lot of components are there. So it is part of other equity, which is other component, separate component. Not OCI. In our statement of charges equity, we can show it as a separate column there with the heading. It is like the way we do accounting for compulsory convertible debentures or compound instrument. Similar way the accounting can be done. See, you are talking about from the joint venture company accounting, or you are talking about from the investment company? Correct. So basically, it is the same similar way you do. It is a compound financial instrument. As far as the joint venture company is concerned, it is a accounting of a compound financial instrument, because you are receiving a loan, plus you are receiving an equity by way of the receiving a certain benefit which generally is not received. So it is a more of like accounting of compound financial instrument from investment point of view, joint venture company point of view. Other equity. Okay. Any other questions? No, but it's always good because question gamme te hoy, but ultimately if we just try to think from different angle, he has been actually covering a very important angle from the other perspective. So then we are able to understand as a consolidated group how it is reflected. So from joint venture companies also and from investment also, both sides we need to understand how it is going to be reflected. classification and presentation of accrued wages and salaries to employees under trade payable or provisions current. The company in question is a Mini Ratna category 1 PSU, mainly functioning in e-commerce and trading. Accrued wages and salaries to employees were accounted for under trade payables, 21.71 crore, out of which 142.03 crore total trade payables. Auditors argued to present under provisions current. Management position, they believe accrued employees' obligations for wages perks arising from services rendered and wages agreement are analogous to accruals and should be classified under trade payable based on interpretation of Ind AS 37. Issue: whether accrued wages and salaries to employees should be classified under trade payable or provisions as per Indian accounting standard Ind AS. આ એકચ્યુઅલી ક્વેશ્ચન આમ ઘણી વાર વિચારીએ ને તો આમાં આટલું બધું વિચારવાનું. સી જનરલી વી મિસ આઉટ ટુ અન્ડરસ્ટેન્ડ અબાઉટ ધ બેઝિક થિંગ. કદાચ કોઈ છે ને પરપેચ્યુઅલ ડેટ આવી ગયો હોય, સબોર્ડિનેટ ડેટ આવી ગયો હોય, ઇન્ટરેસ્ટ ફ્રી લોન આવ્યું હોય તો આપણે બધા અંદર જઈએ ડિટેલમાં કે ઇન્ટરેસ્ટ ફ્રી લોન છે શું કરવાનું, આમાં શું કરવાનું. અને સમટાઇમ્સ વી ફોરગેટ કમ્પ્લીટલી અબાઉટ અક્રુડ વેજીસ. સાલ એમ્પ્લોયીને જે પેએબલ હોય એ તો આમાં શું વિચારવાનું હોય, એ બહુ સિમ્પલ છે. નાઉ સો દેટ્સ વાય I invite all of your suggestions that where it should be presented. Or other financial liability. Okay, fine. Correct. Anything else? It is liability, it is not a question of provision. Fine. Anything else? Correct. So basically why they argue now, I'm being a CAG auditor. So it is not absolute liability. The amount which is payable, accrued wages, I may pay after 1 month, I may pay after 2 months, I may pay after 3 months, right? So provision says estimation involved. And when I will pay, that estimation is also involved. So when the degree of estimation involved, it is not a liability. That's what I argue as an auditor. Estimation, because timing of payment is estimated. I estimate that amount may be payable after 1 month, but company may pay after 2 months also. Generally, it is paid every. I can also see post balance sheet date, and then I can see it is within 7 days paid. But it is again estimation involved.
Payable within time limit. Which is actually statutory liability payable within a specified limit. I mean, if they not pay on account of financial ground, it is a different story.
Correct. Agree. So estimation which is involved under Ind AS 37, whether the estimation is only for amount or estimation also includes the timing of payment. No, I'm just. Correct. Any other? તમારું વસ્તુ I think I accrue wages દરેક ફાઇનાન્શિયલ્સમાં હોય છે. અને એ વખતે ઓલવેઝ યુ વોન્ટ ટુ એસે સમથિંગ? નહીં, અચ્છા, હું તો આમ કરતા એટલે કરે છે. દીપેન, મેં શું કહો છો? હા, હા, સારું, ગજબ કન્સેપ્ટ છો. એકચ્યુઅલી અક્રુડ એન્ડ ડ્યુ, અક્રુડ બટ નો ડ્યુ એવો ગંદો કન્સેપ્ટ વર્ષોથી ચાલતો હતો. આપણે EASમાં તો બહુ હતો. આફ્ટર ઇન્ડિયાસમાં થોડું આપણે ભૂલી ગયા હતા. કારણ કે EASમાં તો શેડ્યુલ 6 આપણું જૂનું હતું ને એની અંદર બી અક્રુડ નોટ ડ્યુ, બટ નોટ ડ્યુ. ઇવન જ્યારે બી ઓડિટર આવે ને CNGમાં અમારી ગવર્મેન્ટ ઓડિટની અંદર તે પહેલાં એ જ જો અક્રુડ એન્ડ ડ્યુ, અક્રુડ બટ નોટ ડ્યુ. મેં તો ભાઈ છોડો હવે આને, અક્રુડ એન્ડ ડ્યુ બટ નોટ ડ્યુ. બટ આઈ થિંક સમથિંગ વિચ ઇઝ વેરી ઇમ્પોર્ટન્ટ ટુ અન્ડરસ્ટેન્ડ. નાઉ લેટ અસ લુક એટ વોટ this ICAI is mentioned here. They said there are 3 very important things. One is it first you decide is it liability or provision. So for a provision you have to refer to Ind AS 37. Is it liability or not? For that you have to refer to Ind AS framework. And whether it is expenditure or not, you have to refer to Ind AS 1. So we need to refer to Ind AS 37, Ind AS 1 and also Ind AS framework. Ind AS framework provides you guidance what is asset, what is liability. And it is defined in Ind AS framework that liability is a present obligation arising from past event, the settlement of which is expected to arise a future cash flow, cash outflow. That is what is defined in Ind AS framework liability definition. And in this framework, it says that change in liability, change in asset will result into the income expenditure. Under Ind AS 1, it says that if it is income or expenditure, it should be recognized as expenditure, and with liability, then it's a different story altogether. Now coming to Ind AS 37. Ind AS 37 defines provision. And for provision, it says that whether the degree of uncertainty is there, then it is not a liability, it's a provision. And degree of uncertainty has two things. One is a possible obligation. And second is a present obligation, but the outflow is not reliably measurable. So there are two aspects of Ind AS 37. One, if it is a possible obligation. A second is if it is a present obligation, but outflow is not measurable. Now here in this case, it is not possible obligation, it is a present obligation. Second, if it is a present obligation, in that case, outflow is measurable. There is uncertainty of the timing, but that is not a case as far as Ind AS 37 is concerned. So it is not a provision as far as Ind AS 37 is concerned. Now coming to its liability. Now for liability, is it a trade payable or other current liability that he mentioned? Now it is said that it is not a trade payable, and it is not arising from your operations and operating activity, which is being defined as part of trade payable, and is other current liability, and therefore it is not to be shown as either trade payable or as provision, but it should be shown as other current liabilities. Fine? Any questions on this? હા, બટ લોકો છે ડિસ્કશનમાં તો મજા આવે ને, ડિબેટમાં તો મજા આવે ને. ઇન્ડ એસમાં સૌથી વધારે મજા ખબર કેવી છે કે ઇટ ઇઝ પ્રિન્સિપલ સ્ટાન્ડર્ડ, અને પ્રિન્સિપલ સ્ટાન્ડર્ડ હોય ને એટલે એની અંદર ડિસ્કશન હેપન્સ. તમે વિચારો, વેન ધ એની ક્વેશ્ચન્સ હેઝ રીચ ટુ ધ ICAI લેવલ, સો અન્ડરસ્ટેન્ડ ધ કાઇન્ડ ઓફ કોન્ફ્લિક્ટ એન્ડ આર્ગ્યુમેન્ટ હેપન્સ બિટવીન મેનેજમેન્ટ ઓડિટર, and therefore they are unable to take decision, and they say ભાઈ હવે શું કરીએ, approach to ICAI એ કેસ માનીશું આપણે. અને જે when they approach ICAI, they both are incorrect. ICAI says it is other current liability. So there is no question of either a trade payable or provision, it's other current liability. Classification of provision for doubtful dates no longer required return back as other income or other operating revenue. A Miniratna Category 1 company, primarily an e-commerce service provider, created a provision for doubtful debts of rupees 94 crore in earlier years. In financial year 2022-23, rupees 18.26 crore was recovered, with the remainder written off as a bad debt. In its financials, the entire 94 crore provision was written back as other income in the profit and loss statement. The CAG objected, arguing these goods should be classified as other operating revenue, since it is related to trade receivable from normal business. Management argued that only revenue from current operating cycle are operating income, and reversal of earlier provisions are not part of the normal course of current operations, hence rightly classified as other income. Issue: should provision for doubtful debts no longer require return back to be other income or other operating income in the P&L account? Other income. બીજું કોઈ? અધર ઓપરેટિંગ ઇન્કમ ક્યાં આવ્યું? અધર ઓપરેટિંગ ઇન્કમ કોણ બોલ્યું? યસ સર. કંઈ નવું જ મજા આવે. સાચું ખોટું ઇમ્પોર્ટન્ટ છે જ નહીં યાર. સાચું ખોટું જો ખબર હોત ને તો લોકો આ ક્વેશ્ચન ત્યાં ગયું જ ના હોત. એટલે તમે હું સાચો હું ખોટો એ ઇમ્પોર્ટન્ટ છે જ નહીં. ઇમ્પોર્ટન્ટ ઇઝ ટુ કન્ટ્રીબ્યુટ, ઇમ્પોર્ટન્ટ ટુ ગીવ યુ યોર સજેશન્સ, રાઈટ? બિકોઝ આ જેટલા બી ક્વેશ્ચન ગયા છે એ ક્વેશ્ચન કેવા છે જેમાં કે ડાઉટ હશે તો જ આ લેવલ ગયા છે, તો એ ડાઉટ તમારો બી હોઈ શકે છે અને મારો બી હોઈ શકે છે. ફાઇન.
When the amount was created, 94.1.
Correct, correct.
It was from our operational income, right? And that
I am not saying right or wrong. તમે સાહેબ કહો. હા,
should be operational.
ઓકે ફાઇન. સર કહે છે કે જ્યારે એ એમાઉન્ટ રાઇટ ઓફ કરી એ વખતે એ એમાઉન્ટ રિસીવેબલ હતા, એ ઓપરેશન્સમાંથી આવ્યા હતા પૈસા, તો ઓપરેશન में थे, રાઇટ? નાउ ઇટ ઇઝ પાર્ટ ઓફ ઓપરેટિંગ ઓનલી. ફાઇન, દેટ ઇઝ વોટ યુ આર સેઇંગ, કરેક્ટ? ઓકે, દેટ વોઝ CAG also argued. Okay, any other thought process? Sorry? Huh. Wonderful. That is the answer. So basically under Ind AS 109, when you just talk a provision for doubtful debt, that is not under the Ind AS. Provision for doubtful debt is nothing but the ECL methodology of arriving at the provision. So that is impairment loss. And for any impairment loss, there has to be a separate line item which is required. Same way when there is a reversal of impairment losses, that again a separate line item is required. It is not other income, it is not other operating income. We do understand it is a reversal impairment loss, and impairment loss is under ECL methodology. Therefore, it is with separate line item, not other income, not other operating income. Accounting for leasehold land and applicability of Ind AS 116. A special purpose company, Government of Karnataka and Government of India obtained land from KIADB via lease for a major infrastructure project. Original lease was for 99 years. Later amended to 2 years lease cum sale with intention to register the land in the company's name after 2 years. The company applied Ind AS 116 leases recognizes right of use asset and lease liability disclosing ROU as an inventory and did not amortize the asset, arguing the land's useful life is infinite. Issue whether the presenting ROU as asset is inventory and not depreciating it is correct as per Ind AS 116 given the lease cum sales structure. So basically, let me just give you a basic background of Ind AS 116 and then we'll talk about the case study. Under Ind AS 116, there is a move from Ind AS 19 to Ind AS 116, where it says that whether the lease is financial lease, operating lease, આપણે જે જૂનું વર્ષોથી ચાલે એ પ્રમાણેનું ચાલે છે. And if it is like operating lease which is been taken, then it is not called only lease rental, but you get a right to use the asset for a particular period of time. So therefore, in such case, leasehold lessor should recognize ROU and then the lease liability should be accounted. This is what Ind AS 116 talks about. The question which has been here is that the company has applied and recognized ROU, and ROU was shown as an inventory and it did not amortize assets. So if ROU is shown as inventory, then Ind AS 2 comes into picture. Ind AS 2 says cost of NRV which is lower. Had it been part of the PPE or ROU separately, then I will amortize over the useful life. But the company has taken as part of inventory, not as a PPE. Now CAG argues that it is not inventory. It should be part of the separately should, and then you have to do depreciation amortization. That is what CAG argued. What is your view? It is not inventory. Okay. It is depreciable asset, but not inventory. Sorry? Part of inventory. Okay. Correct. So basically what he is trying to say that inventory or PPE, it all depends upon the purpose for which it has been used. He argued that saying that the purpose of that particular is for my own business and operations, which I am going to transfer. Therefore, that is his inventory. When you say PPE, you are saying that it is not been transferred, it is for own use. So it is a PPE, that's what you are arguing, right? Okay. Okay, fine. So basically, I think the substance over legal form is a principle based. That is a very, very common and very, very important perspective to understand in every transaction. First of all, what ICAI has done that we need to do, they say that let us look at, is it first ROE or not? Because the lease period was 99 years and later amended to 2 years lease cum sale. So a lot of discussion was happening to see that whether the amendment of that lease term from 99 years to lease cum sale for 2 years, does it mean that it is not a lease and it is a financial lease? Not an operating lease, it's a financial lease. If it is a financial lease, then can it be treated as a asset purchase rather than ROU? Because ROU primarily means that the purpose is operating lease. And operating lease is for a particular period. But when you just look at the 99 years of lease which is being converted to 2 years lease cum sale, and the object itself seems to be for buy and sale, only the color has been kind of lease which is started. So we need to just look at substance over legal form, and that substance means that this is actually a finance lease where the company intend to get the particular asset in the books of account. So ROU treatment is not a correct, and therefore it should be recognized as if it is a financial lease. The accounting shall be done accordingly. Now whether it is a PPE or inventory, that all depends upon the purpose for which it is to be done. So therefore we need to look at if it is going to be transferred to the consumer, then it's inventory. If it is not to be transferred to by consumer, but it's to be used by a company of even for a business, but if it is to be used by a company, owned by a company, not to be transferred to a consumer, that is a PPE. So that is what is the discussion so far as far as the standard is concerned. Accounting treatment and classification of sales bills discounting. The company's sales of power and coal ignite mainly to state discoms with payment credit periods and a surcharge for late payments. To improve liquidity and avoid interest for late payments, discoms can use sales bill discounting via banks. The bank pays the company upfront and the discom settles later with the bank. The SBD is with the recourse. If the discom defaults, the bank recovers from the company, which then claims from discom, including surcharges. The company believes it transfers substantially all the risk and rewards and derecognizes receivables, showing potential exposure only as a contingent liability. Issue: whether derecognizing trade receivables and classifying exposure as a contingent liability under this SBD arrangement is correct as per Ind AS 109. Yes. Okay. Okay. So he is of the view that there is no like 100% is being passed. Company argues here, there is no question of 100%. It's a significant risk reward transfer. So company also says that now just look at that, you are saying not passed, but look at substance over form. Contract में कुछ भी लिखा है. Look at substance over form. Substance over form is just look at last 5 years history. Not a single amount which is fall on me. Not a single time the bank has come to me asking that he is not paid. You know, discom, there's similar thing which is argued by company. Say that discom is part of government of India. It is 100% guaranteed. There is no risk to me. The agreement mentioned these things, but however it is only a customary part. It is not actually a substance. I'm arguing. I'm not saying I'm right. I'm arguing as a company management. Okay, but look at the history. Means look at the past. It is discom is what? Discom is not like a private company. It is by government. 100 government owned. Government तो पैसा देगा तो ये मैं भी government वो भी government है दोनों government है, and they are paying money. It may be delayed. Look at the past history. Okay, fine. Any other view? See, this may be a very like sometimes in practical life these kind of things are generally happening because liquidity crunch and the financing is a very important part of any corporations. So therefore the company entered into this kind of arrangement with the bank, wherein the bank makes payment to the company So whether to be accounted as a reduction in the trade receivable or not, it has huge impact because your trade receivable can come down, may not come down. These all have impact on presentation of companies' financial statements. Any other view?
I think it's really zero in the time and secure loan.
Okay. So similar with the similar thing which he's talking about, right? That's what similar view. Same view, right? Okay. Fine. So I think all are having similar way. You are saying trade receivable not to be reduced. That is the common view here. Anybody who is saying the trade receivable to be reduced? No. Fine. That's correct. I think trade receivable should not be reduced because the recourse is there, and when you just look at the derecognition of financial liability, India is 109, that provides you certain conditions for derecognition. So derecognition of financial liability has a specific condition written, and that condition is not satisfied for derecognition. So substance over form is always there, but substance over form cannot happen in everywhere. Then there is no standard required at all. But you do just look at the conditions which are written in this 109 for derecognition, and that condition is not fulfilled as a derecognition of financial asset is concerned. Therefore, the trade receivable will not be derecognized, it will still continue, and then you can have separate liabilities which is received from the bank till the time actual amount is received by the bank from the discount. Treatment and presentation of perpetual loan. A Government of India owned company, Minister of Defence, 100% equity is engaged in shipbuilding and repair. The government approved a financial restructuring package in financial 2010-11, totaling 824 crore, of which 452 crore was given as a grant in aid to clear liabilities. 372 crore was existing government loan, accrued interest and guarantee fees was converted into perpetual zero interest loan. Until financial year 2023-24, the company prepared its accounts as per IGAP, classifying this perpetual loan under long-term borrowing. For financial 2024-25, the company transitioned to Ind AS, preparing first Ind AS financial statements. Under Ind AS, should 372 crore perpetual loan to be classified as equity, and if so, what are criteria for recognition, classification and presentation in financial statements? So there are two loan, one is of 452 crore rupees, which was given as a grant in aid, and second is 372.22 crore rupees. As far as 452 crore rupees, there is no dispute as such. But just to say that it is a part of grant in aid, so we need to apply Ind AS 20, government accounting, and by applying Ind AS 20 government accounting, we need to recognize that, in my view, it should be immediately because it is to clear liabilities. So it's immediate recognition because my liability is already there. So Ind AS 20 says you have to recognize immediately. Second is where the point of dispute here is that about 372 crore rupees. That is existing government loan, accrued interest and guarantee. That was converted into perpetual zero interest loan. So the word is loan, the amount is being converted, plus accrued interest converted into perpetual loan, but it's a zero interest loan. How is the accounting to be done? It can be considered as what? Okay, fine. Siddharth mentioned the point that it is to be considered as an instrument entirely in equity. Now, any other points? Any other questions? I think we all agree on that, but I'm not debating on this. If you have any question, I think that's a very straightforward point. But still, it is always doubtful because we are moving from AS to Ind AS, and we have never imagined this kind of loan. When the word loan comes into picture, we always believe the loan is loan, right? Loan is I don't repay. How can it be equity? So first, it is equity because it says the perpetual is what? Where is it? Zero interest loan, perpetual. So zero interest loan perpetual, that means it is for a lifelong with the interest rate to be not provided. So as far as Ind AS, we welcome Senate Council member of ICAI, CA Pushottam Khandelwal from Home Branch, CA Sanjeev Singhal ji, CA Vishal Bhai Doshi ji. Let's have a big round of applause for them. Vishal Bhai, ESB chairman vice chairman आया हुआ तो भाई मारे आ तुम्हारा EGS में प्रोग्राम થઈ રહ્યો છે. So as far as Ind AS 32 is concerned and the presentation of Ind AS 1 is concerned, the equity is divided into three parts. One is A is share capital, B is other equity. Under other equity also there is a separate line item which talks about the entirely nature of equity. Like equity in this instrument having entirely in the nature of equity. Now this perpetual loan with a zero interest is in that particular classification, therefore it will be shown is as such in my equity, other equity. Accounting for commission paid to performance bank guarantee. A joint venture company between two PSUs was set up to operate city gas distribution networks in Ambala, Kurukshetra and Kolhapur. After obtaining PNGRB, the company had to provide a performance bank guarantee of rupees 1,948 crore rupees, equally shared between the promoters. The PBG was an unavoidable precondition to obtain authorization and enables the JV to secure exclusive rights to operate city gas infrastructure. The cost of PBG was charged by promoter to the company and was capitalized as a part of capital work in progress following Ind AS 16. So the bank guarantee was provided by the company and that was being taken as a part of the CVP. The CAG objected, stating that the capitalization overstates profit and assets, calling it a prior error and suggesting it should be a revenue expense as per Ind AS 23 borrowing cost. Is the capitalization of bank guarantee commission for a PBG as done by the company appropriate under Ind AS 16 or should it be expensed in the profit and loss account? Now in this particular case, what happens that commission has been paid and then the question is that whether it is to be capitalized or is to be expensed off. In earlier case study, we discussed the point that whether it is a liability or not, it is defined by Ind AS framework. And Ind AS 1 talks about a case that in case of any income or expenditure, it should be taken to profit and loss statement. So the interest can be capitalized or the fees can be capitalized only in which situations? So first issue is that if it is Ind AS 23 borrowing cost. Now borrowing cost Ind AS 23 can be capitalized if it is for qualifying asset. So is it a qualifying asset or not? That is the first situation. If it is not a qualifying asset, the ICAI has argued that if it is not qualifying asset, the Ind AS 23 is not applicable. Now we have to look at Ind AS 101 first time adoption. Because the argument was that under Ind AS 101 first time adoption, when you move from AS to Ind AS, it provides you one question wherein certain amount can be capitalized. However, it is not part of first time adoption, therefore it is not being capitalized. So by applying that analogy, these particular things is to be expense of, not to be capitalized, which is done by the company. I will take few questions. I think how much, Rinkesh bhai? 5 minutes? Okay. 5-10 minutes? Okay. Let us take one time value of money while calculating ECL on deferred debt retention money. I think this has been one of the very, very important questions and still I can see the industry is divided. A lot of companies are following a different policy and very, very less clarity is available as far as this particular question is concerned. The company is an integrated power plant equipment manufacturer engaged in design, engineering, manufacture, construction, testing and commissioning of power projects. The contract provides that a specified percentage of each milestone payment is to be withheld. That is retained, known as deferred debt, by the customer throughout the arrangement and paid to the company only when the specified milestone of the project are complete. This amount is withheld by the customer purely for the purpose of protecting itself. See, I think there are a lot of EPC contract company which just identify a lot of large size company where the project is a very huge period and for a period of time which is next 3 to 5 years. Certain percentage of the amount is retained. The purpose of retaining the money is for a performance kind of guarantee. Because if after 3 years, if something not happen, then how can they recover the money? So that it is called retention money. The company provides for expected credit loss on trade receivables, including deferred payment. Now, for example, 100 crore rupees is the amount which is invoice raised. As far as the retention money clause is concerned, it's a 10% money in every invoice to be retained. So 90 crore is the amount receivable and 10 crore is retention money. The company recognizes the provisions by applying Ind AS 109 ECL model. For recognition of ECL model, they do provisioning on 100 crore rupees. The CNG auditor argued that 100 crore has two main criteria. One is 90 crore, which is amount to be receivable immediately within 30 days, 60 days credit period. And remaining 10 crore is retention money, where the amount is not going to be received in a near future. So the recognition of ECL should be separately on 90 crore and on 10 crore rupees. Now, here it says that the management argued saying that let's just look at Ind AS 109. Under Ind AS 109, it says you have to use simplified methodology of application of the ECL. By simplified method of using allowing ECL, it allows you to have provision matrix approach. And as per provision matrix approach, we have allocated that amount of 100 rupees to these particular things, and then we have applied the provision matrix. Now, what is your view? Whether we have to look at the discount rate, whether we have to also have separate amount of provision of ECL on 90 crore and 10 crore rupees. My question is clear to all of you. I think this case study is clear to all of you, right? So there are amount of invoice of 100 crore is raised, 90 crore is for receivables and 10 crore is for retention money. Now, the company has carried out provision ECL on 100 crore rupees. CNG argues that no, ECL should be done separately for 10, separately for 90, because retention money of 10 crore is to be receivable after performance is there. It can be 3 years, it can be 5 years, based on the condition. So you have to do discounting of the 10 crore while calculating provision. So there are two questions. One is the measurement of financial asset. Second thing is the ECL on the financial asset. The question at the per se is not on measurement of financial assets. There is no doubt, there is no question which is raised on 10 crore or discounting of retention money. That is again a very crucial question. However, in this particular query, the question is on ECL provisioning on a 10 crore. Whether 10 crore correct or not correct, there is no question. ECL provisioning on 10 crore, and for measurement of ECL, whether I should look at the discounting part of the is 10 or not, only for measurement point of view. So you are of the view that 90 crore to be done separately, 10 crore to be done separately. On a 10 crore rupees, time value of money is to be considered. And when you say time value of money, it is not only provision matrix. It is in addition to provision matrix, we have to understand when the amount is going to be received. Right? Any other view? I think that's really actually, it seems too easy to understand. It seems easy to discuss and give a solution, saying that on the 10 crore of retention money, you have to consider time value of money, but you just look at the reality of competition of that particular ECL separately on retention money by doing time value of money is a very complex part. But however, what ICAI has opined here is that you have to consider that time value of money also in ECL. So as I mentioned, there are two main parts. First part is a recognition and measurement of the amount that is at 90 and 10. It is not debated, is it 10 or correct? In my view, and which is written by ICAI, 10 also can be not correct. It has to be time value of money in 10 also. Secondary part which has been argued here is about the provision on 10. Even for doing provision, time value of money is to be considered, not only for measurement of financial asset. That is also covered under Ind AS 109. So it all talks about the case where we need to also consider the time value of money even for retention of money in doing provisioning. Let us take one case on Ind AS 19. The company has a social security scheme for providing specific financial assistance to dependent family members of the employee who dies during the service period. Features of the plan. The company is to contribute rupees 4.39 crore annually at the beginning of the year. The monthly contributions made by the members shall be non-refundable. No amount is payable to the employee on his or her superannuation resignation from the services of company. As and when any death claim is registered, the amount shall be withdrawn from LIC and paid to the nominee, dependents of the members. If in any financial year the cash required for meeting the liabilities of trust fund is less than the asset available, the shortfall shall be made good by the company by making an additional contribution equivalent to the amount of deficit. If an employee dies after service life, the dependent members are not eligible for any financial assistance from the trust, and accordingly the company is of opinion that it is neither a defined benefit plan nor a defined contribution plan as stated in paragraph 8 of Ind AS 19. Whether SS trust should have a defined contribution plan or defined benefit plan. Let me just give you what is primary thing which is argued by the management here is that it says when you just look at the Ind AS 19, under Ind AS 19, the classification of employees are four. One is a short-term employment benefit. Second is a post-employment benefit plan. Third is other long-term, and fourth is termination benefit. What it says that the part is the post-employment benefit plans has two aspects. One is a defined benefit plan, and second is defined contribution plan. The management argues that the benefit or social security fund which they have started, that SSS scheme is not for post-employment. Because if you talk about different contribution plan, different benefit plan, if it is a part of post-employment benefit plan, but post-employment means what? After employment, if you receive, it is a post-employment. Here it says that during the employment, if the employee died, then the amount to be payable. With the during employment, if the employee died, the amount is payable to the family of the employees. So it is argued that it is not part of the post-employment benefit plan. Therefore, they said there is no need to do actual evaluation. I think are you okay with me? So how many says that it is not, actual evaluation is not required? Do you think it's required? Actual evaluation is required? Yes or no? Yes. So there are four categories. One is the short-term employment benefits. Second is the post-employment. Third is termination. Fourth is other long-term employment benefit plans. So even if it is not post-employment, it is other long-term employment benefit. Under other long-term employment also, there are two parts. It's a defined contribution plan and defined benefit plan. And when you just look at this line, it says, in case of shortfall of the fund, it will fall back on the employer, on the company to make contribution. So it is called defined benefit plan, part of other long-term employment benefit plans. Therefore, the actual evaluation will be required and all the disclosures and accounting will follow, which is applicable for other long-term employment benefit plans. I think we'll have maybe take one last, then we can look at. Let us look at major spares and then we'll come to the conclusion. Major spares are procured and kept in store to ensure uninterrupted operation of the plant and machinery. When a spare already in use is damaged, new major spare is used for replacement of damaged one. Such spares are required to be fitted into the machine with appropriate technical settings and installation to make it capable of operating. In some cases, the cost of major spares include procurement cost as well as the cost of installation and commissioning, which is recognized only when such major spares are installed or commissioned or fitted to the equipment. Management intends to make the spare available at the location and the condition as required by the machine where the spare is to be used. Therefore, the company considers the date of issue as the timing of availability of the spare for use. Is the view of management correct? if you just look at a lot of companies, there is always debate on whether spares is a PP or not. I think the first debate is spare is PP or not. That is the first debate. Then second debate coming to picture is the depreciation start. Here the question is primarily more the depreciation start. But the first debate is what, whether the major spares is to be considered as a PP or not. That is the first debate. Correct. So, okay, fine. Okay. Passive use is relevant. So passive use means you want to say that if it is like emergency spares, right? It is needed. So then it's always PP. Okay, fine. So useful life more than 12 is more important for you rather than the any other reason. Okay, fair enough. Any other? Oh, sir. We welcome past president of ICAI, CA Sunit Reddy, sir. Yes. So, basically here the first question was that recognition of the spare parts either as an asset or as an inventory on consumption. That is the first point which has to be discussed. Now, when we move from AS to Ind AS, under Ind AS, the recognition is being covered by Ind AS 16. Under Ind AS 16, it says that whether it is to capitalize or to be expense of, it all depends upon the conditions of recognition for property, plant, equipment. Under Ind AS 16, it says that property, plant, equipment shall be recognized first when the future economic benefit is expected to be received. So probable FEB. So FEB is very common name as far as Ind AS 16 is concerned. And second very important thing is that whether cost is reliably measurable. So on that principle, we have to assess whether that major spare part is falling or not falling. Then based on that, we need to arrive at that is it capitalized or not capitalized. Now in that case, ICAI has made it point that we are not talking about discussion about whether it is capitalized or not capitalized. It is not the query at this juncture. But however, for recognition point of view, you need to look at these two conditions, you have to assess these conditions, and then you have to arrive at is it a PPE or not PPE. Now, assuming it is PPE, the second question which is into a particular query is about depreciation shall commence where. Because if it is PPE, then there is a question of depreciation shall commence when. Now, for that depreciation, Ind AS 16 mentioned that the depreciation shall commence when the asset is available for immediate and present condition, right, for use. So, the start of depreciation is from asset available for immediate and present condition. Now, here management argues saying that the asset is to be usable only when it is required. And if you start depreciation from the day I purchase, there is possibility that I am doing double depreciation. Because the spare parts are part of machinery on which I am already providing depreciation, and the spare parts are kept in here which is not being used. And if you want depreciation on that part also, there will be double depreciation on the same spare parts. Therefore, they argued that it is not to be started depreciation. However, it was being rejected, saying that the depreciation should start on the date on which it is available for use. Once you cap the spare parts, then they are ready for use. It is not the date on which you install spare part in machinery, and the date on which you do replacement is not important. However, you should start depreciation when it's available. And that is the most important as far as is concerned. Now coming to last slide before we, the key takeaways as far as this particular session is concerned. So far we discussed in all these questions, substance over form. I think for so many times, even participants have talked about substance over form. And when you just talk about Ind AS, it is much more of like understanding the real reason, real nature of transactions, rather than the legal form, how it is formed. Time value of money, which is one of the most crucial principles to be considered, either it is a subordinated date, interest-free date, perpetual date, or it is a revenue recognition. The time value of money is considered. Third, old gap thinking, I think that need to be changed. Because a lot of cases when we look at, we look at the old AS, see, we look at the Schedule 3, Division 1, Schedule 6 of Companies Act 1956. So in our mindset, still the old gap is coming into picture. So that need to be completely changed to arrive at where India is required. Classification is the most important part. How you classify, whether it's an asset, liability, income, expenditure, whether it's a liability, there is financial liability, other current liability, trade payable. That is the essence, because the investors make a decision based on how it is presented, how it is classified. Root cause of error is applying accounting mechanically. The role of the auditor is the most important thing. As I mentioned last, professional. Because when the standard is based on principle, every transaction has two aspects. If the auditor doesn't apply the judgment, if the auditor doesn't challenge the judgment, then probably the accounting can give it wrong. So the role of profession has been most crucial as far as India is concerned. So that is what is learning. These expert advisors' opinion which are taken are only selected. There are more than 300 expert advisors' opinion are available on ICAI website. And the purpose of this particular session is to just give you idea about the wealth of knowledge available with ICAI. So my humble request to each one of you, we can have a habit of reading expert advisors' opinion to learning it. It's the best way to learn Indians. And with these brief words, I am thankful to each one of you for having active participation. Because Friday, working day, and you all have been there from 9:30 sharp till 5 p.m. It requires determination, it requires March end, a lot of pressure in year end. Still you are here to listen. That's really credible to all of you for your sincerity towards learning Indians. And my thankful to the chairman, ICAI Ahmedabad branch, for giving me opportunity. I'm sure that, as I mentioned earlier, that Rinkesh Bhai has been even a technically sound person, and a lot of sessions are going to happen in your leadership. So with this brief word, thanks to each one of you. Again, thank you very much.
I sincerely thank CA Chintan and Patel sir for his insightful session on recent EAC opinions. Your practical approach and clarity have truly added value to all of us. Thank you, sir, and thanks to all present for making these sessions successful. Thank you.